All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using life insurance, you've come to the right place. So please be sure to like this video and subscribe to this channel so that you're notified whenever I come out with a new video. Today, we're going to be talking about single premium life insurance. And more specifically, should you be using a single premium life insurance policy for investing in real estate? In theory, it sounds really good. You can take your savings and dump it into a life insurance policy and begin to immediately leveraging it to build wealth investing in real estate. But the reality is if you understand the inner workings of a life insurance policy, you can understand why this is not really a good idea for you. So if you're interested in learning those reasons, stick around after the intro and I will unpack it all for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and I'm a life insurance agent, and I design life insurance policies that are optimized for investing in real estate and tax-free retirement income. The goal of this channel is to give you all of the content that you need to understand how this works without ever talking to a life insurance agent. If you do have any questions that I don't address in this video or any other of the videos on my channel, be sure to post your question in a comment and I'll be sure to get back to you as quickly as possible. I like to see it in the comments just so that other people can benefit from the response that I give you. So before we get started, let me just handle my usual disclosures. The primary purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. Secondly, all of these videos are purely educational. There's no soliciting, no selling, no financial advice, no tax advice. My goal is just simply to explain how you can invest in real estate using a life insurance policy. So be sure to like and subscribe to this channel. And also, if you have any underwriting concerns, whether it's overweight, diabetes, heart conditions, high blood pressure, be sure to check out my new side project, which is Radical Recovery. It's a Facebook group that I started where I post all of the latest research into natural healing remedies. So a lot of times you can take care of your issues without resorting to pills. So if you are taking pills for anything, you owe it to yourself to check this out and at least learn what you can. And finally, in this video, I'm not going to be covering any of the Life Insurance 101. So I highly recommend watching the Life Insurance 101 video if you need some more background information on how life insurance works. And I think the video on life insurance policy design, the difference between minimum and maximum overfunded policies, would also be a good one to watch prior to this one. And then I've also got one more video that covers in more detail the policy fees and expenses so that you can understand that. And that will really relate to how this works. So with that, let's get started. The goal of this presentation is to explain to you why you don't want to use a single premium life insurance policy for policies intended to invest in real estate. And that really applies to anyone who's starting off a policy with a large initial premium and following it up with subsequent premiums of a lower amount. All right, so the agenda for this video is I want to cover why you don't want to use a single premium life insurance for investing in real estate, the double play. I want to go over just an example of the financials, the expense report of the policy so that you understand exactly why that you shouldn't be doing that. And finally, I want to follow that up with how you should structure a policy if you have a lot of savings that you want to use. So single premium life insurance policies are really intended for people who want to buy a paid up life insurance policy with one single premium. And the key there is a paid up life insurance policy, meaning you don't have to put in any other premiums after that. Most of the time, these policies are what you would consider a modified endowment contract. And I haven't spent much time or videos explaining what a modified endowment contract is, but most life insurance policies endow at age 120. That means that by age 120, you would have saved up 100% of your death benefit, and it would basically pay that to you. So modified endowment kind of implies that you're overfunding it beyond the level that's necessary to reach that limit at age 120. Now, that's great if your goal is for the death benefit protection. One and done, you're done with it. But for anybody who wants to utilize the policy for real estate investing, those modified endowment contracts come with tax penalties. Any loan against the policy is going to be taxed as ordinary income. So that just plain doesn't work. And if we design these policies so that the death benefit is minimum non-MEC, so we're getting as much death benefit as we can without going over that MEC line. So basically, we're paying as much money as we can and still not violating the MEC limit. Well, when you do that, the fee structure on the policy is set up so that the fees are being recovered over 10 years of the first 10 years of the policy. So that initial premium and the cash value that results from it is going to be eroded over the next 10 years. You're going to be giving a lot of the money back to the insurance company in the form of fees. So what I want to do now is move on and just show you a numerical example. This is going to be an indexed universal life because IULs, you can include an expense report that details the expenses on the policy. Whole life policies don't have that feature. But it's important to point out that the fee structure is virtually identical between a whole life and an indexed universal life. So in a properly designed maximum overfunded policy, you can be assured that what I'm showing you here is pretty much what it's going to look like for you. And the other thing I guess I should point out too is don't focus so much on the numbers that I'm showing you. Everything in life insurance is scalable. And what that means is, while I may be showing you a policy with a $36,000 lump sum premium followed by $12,000 a year, you could do $100,000, you could do $200,000, and everything is proportional. All right, so what we're looking at here is a standard policy design. So this is one where the client is simply paying $12,000 a year for his life insurance policy. And it's important to realize that in life insurance, the death benefit is a function of the first year premium. So whenever you're designing a policy, it's important to realize that we're subject to two additional rules in addition to the modified endowment contract that I covered earlier. And that's the guideline level premium rule, the guideline premium test, GPT, and the cash value accumulation test. And really, modified endowment contract, it's important to realize that is still life insurance. It receives very poor tax treatment, but it's still life insurance. The guideline premium test is a test for life insurance. So for any given death benefit, 1 million, 100,000, whatever it is, what is the most that you can pay for that life insurance policy and have it still be considered life insurance? So generally, you can surpass the MEC limit without running into the guideline premium test. So there's a guideline level premium and a guideline single premium. So you can fund a policy up to the guideline single premium, but that is almost 100% of the time going to be a modified endowment contract. The guideline level premium is that premium that you can pay in perpetuity or until age 120 without ever violating the definition of life insurance. So let's turn our attention to this report here. This policy is showing a standard policy design with $12,000 a year of premium. And this is the expense report, so it's showing you across the top. You can see the premium charge, the cost of insurance charge, the policy issue charge, additional charges, And then off to the side, you've got the cash value. The death benefit is off the screen. This policy is being funded for a 45-year-old with premiums being paid through age 65. And let me go over the expenses that you can understand how a life insurance policy typically works. The premium charge is a charge that's based on, as it sounds, on the amount of premium that you're paying. So here, if you do the math, you can see that 660 is exactly 5.5% of every dollar of premium. And most of this money is being used to pay for any kind of expenses that the insurance company has that are based on the amount of premium that they're taking in. So a large chunk of that is paid to the state in the form of premium taxes. So that's not where the insurance company makes its money. The next one over is the cost of insurance charge. Now, again, this is an indexed universal life illustration, but cost of insurance is common across both whole life and universal life policies. And really what this represents in both cases is the amount of money that needs to be pooled in order to cover all the claims on all the 45-year-olds who aren't going to make it to 46 next year. So most of this money gets paid out in the form of claims. And again, that's determined based on the mortality tables and actuarial tables that the insurance company maintains. That's their core competency. They understand how many people out of 1,000 aren't going to make it to the next age. This is all a numbers game. The bigger the pool, the more accuracy they have. And that's the way life insurance works, is each year they simply take from the policy enough money to put into that pool to cover all the claims on all the 46-year-olds who aren't going to make it to 47 that following year. But all that time, the cash value is growing to offset the amount that's at risk to the insurance company. All right, so moving on, the policy issue charge, you can see that is $854. And you can also notice that it runs for the first 10 years of the policy, down through age 54. And over the course of 10 years, that sums up to $8,538. So the key thing here is this is where the insurance company makes its money. This is a charge that's related to the death benefit. And in a whole life policy, you can find this buried in the policy. And typically it's expressed as a charge per $1,000 of death benefit. So if you get out a calculator and do the math yourself, you can come up with these policy charges. But everything that's shown here in tabular form, you can also generally find in the whole life policy documents between the illustration or the policy itself. They're just not laid out in the policy illustration like they are in a universal life. And then finally, the next column over is the additional charges. And you can see that there's just a flat $60 per year for as long as the policy is in force. And that basically works out to be $5 a month. You can think of it as postage and everything else miscellaneous. So that's the fee structure of the policy. The main three are the premium charge, just $5.5% of every dollar. The cost of insurance, which you can see is going up each year. And then the policy issue charge, which is just for the first 10 years of the policy. And I should point out that charge is related to the death benefit. So this is a maximum overfunded policy. So $12,000 is the most that you can pay for whatever the death benefit is that this policy has. I'm not showing it, it really doesn't matter. But you could also underfund a policy. Like you could probably get by with about $4,000 of premium. I mean, if you called up an agent and asked for a policy with this particular death benefit, whatever it is, $4,000 would probably be the normal premium amount for this policy. But that policy would also have a charge of $854. That's because it's related to the death benefit. All right, so I've beat that to death. So let's move on. So in this example, the client is paying a $36,000 initial premium and is following that up with $12,000 a year of premium thereafter. And if you look across, notice what's different here. You can see the premium charge, that's scalable. 5.5% is 5.5%. So that first year, it's a $1,980 charge instead of $660. And then you can see that in year 2, it goes back down to $660. No problem with that whatsoever. However, the cost of insurance has basically tripled. And as I stated earlier, that's because if you're paying a $36,000 premium instead of a $12,000 premium, you've really got to buy 3 times the death benefit in order not to violate that guideline premium test. So in order to keep on paying premium into this policy, you've got to maintain that death benefit. So that cost of insurance is now triple, and that's basically for the entire time that you're paying premium into this policy. Now again, that both whole life and index universal life work just like this. The death benefit is what the insurance company does. It's the most expensive part of providing a life insurance policy. They have to put money into a pool to pay the claims that they expect. So if you triple the death benefit, you've got to triple the amount of money that you're putting into that pool. It's that simple. And then you also will find that the policy issue charge has tripled as well. And again, that's because the policy issue charge is driven off of that death benefit. But here's what I want you to see. Notice that the death benefit Notice that the policy issue charge is that tripled amount, but for all 10 years of the policy. So instead of summing up to $8,000 like it did in the previous example, now it sums up to $22,900. So you can see here that you're giving back a very large chunk of that $36,000 that you put in up front. So it's forming a big drag on the policy. And in fact, if you take all those expenses and add them up and divide that by the amount of premium that you're paying in the subsequent years, you can see that expense ratio is very substantial. We've got about $2,300 of policy issue charge. With the cost of insurance, we're at $27. And with the premium charge plus the additional charges, we're looking at about $3,400. So over a quarter of the premium that you're paying, that $12,000, is being lost to the fees. And normally, if you look in that previous example, the typical expense ratio for a life insurance policy is about 15% or even less. So this is costing a lot of extra money because of that higher death benefit. Now, if you need the higher death benefit and that's what it's all about, great, do this. In fact, you could form a modified endowment contract if you don't need access to cash value and get even more death benefit. But just understand that if you're trying to leverage the policy's cash value for investing in real estate, this is not going to work out for you. You would have been much better off doing something else with your money than putting it into the policy. All right, so what did we learn here? The lump sum policy started with over $24,000 more, but had only $13,310 more after 10 years, and only $9,593 more after 15 years. So from that point forward, once you reduce the death benefit of the policy, minimize the expenses, it will grow over time and have more cash value than the previous one. But it also started with more money too. But that extra $24,000 of premium led to $14,380 of extra policy charges. So you gave back a big chunk of that $24,000 to the insurance company. And not only that, the insurance company, the insurance agent, our commissions are based on the amount of death benefit in the policy. So if you triple the death benefit, you essentially triple the commission to your agent. So would have been much better off by spreading the policy out, spreading $24,000 a year out over 5 years. And then at the end of 5 years, we could just do a face reduction, which would drive down the cost of insurance, but you'd still have that policy issue charge for 10 years. But I find that 5 years is really the sweet spot. You know, it's still heavily upfront and you still have those policy issue charges, but you also have to weigh that against how long it takes to get your money working. So when you do a 5-year funding, you're keeping the death benefit to a minimum and balancing that with the time value of money, which is getting that cash in the policy and exposed to dividends or interest crediting. All right, so how to optimize the policy design for real estate investing. The policy should be designed for minimum non-MEC at issue. And that means, in the case of a whole life, that means as small of a base policy as possible, as much term as possible, and filling in the paid up additions. Paid up additions, I mean, that's the cash in a whole life policy. And then in the case of a universal life, you know, we want to start with an increasing death benefit and then do a face reduction at the time that we stop paying premiums into the policy. And the second bullet point is, you know, this is extremely important to understand. You don't want a lump sum. And I hope that's readily apparent after watching the numerical example that I just showed you. And then finally, while this policy didn't show an early cash value rider, you know, when you're planning on investing in real estate, you want to put a rider on the policy that waives the surrender charges, because you want to have access to all of the cash value and not have it be subject to surrender charges, because surrender charges impact the amount that you can borrow as well. All right, so wrapping things up, any agent who knowingly writes a policy with a single large premium is either ignorant of the impact of what they're doing, or they are knowingly doing it for their own benefit and taking advantage of your lack of knowledge about the impact of that. You know, I have a lot of people who reach out to me and this is what they want to do. And I have to talk them out of doing that and explain to them why they don't want to do that. And very often when I'm reviewing illustrations for people, you know, I see this all the time. You know, the agent took whatever money that they had in savings and designed that as a single large upfront premium, and then followed the subsequent premiums would be whatever that person can afford to put into the policy each year. Huge mistake benefiting the agent who's writing it. So again, it's one of these two. Either they're knowingly doing it, or they're doing it and they don't understand the damage they're causing to you. So last point is just this is an extremely costly mistake to make. That's all I have for this video. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, I highly recommend going out to Facebook and joining my Double Play group there. That's a group of people who are either interested in learning about this or actually doing it. And it's a great place to share your questions and just see what other people are doing. I've got this YouTube channel. Just bring up the channel and just scan the titles. There's a good chance any question you have, I'm addressing it in one of these videos. And then also you can see at the bottom here, I've got a link to schedule an appointment with me. You know, when you're ready to see what the numbers look like for yourself, just go ahead and do that. And then on my website, I've got a ton of information. I consider my website to be a no fluff zone, meaning I'm just providing as much information as I can put out there so that you know that you're dealing with an expert who understands how to design maximum overfunded life insurance policies. But just know that there's a written blog post that goes along with almost all of the videos that I've done. So if you prefer to read or have a backup to remember this video, I'd suggest going out there. Also, if you just want a copy of this presentation, just send me an email. My email is in the description down below, and I'll send you a PDF version of this presentation. And finally, if you enjoy getting all this content for free, consider supporting me financially at buymeacoff.ee. Your support gives me an incentive to keep on creating these videos. With that, I am done, and I will see you in the next video.